Good afternoon, everyone. Hope you're all able to hear me. Hope you're all able to see me as well. My name is Mohan. I'm head of customer success at Credly. I welcome you all to this webinar on new tax regime. Um, I'm audible to all of you, right? Can I get a confirmation on this?
Yeah.
Right. Sure. Thanks. So in today's session, we will talk about complexities of new tax regime, practical and actionable approaches towards tax planning, and we will also talk about potential tax saving opportunities and hassle-free tax filing, which is due tomorrow. This is an interactive session, so we expect a lot of questions from our participants to make it useful to everyone. And our goal is to have an actionable plan by the end of this session. So please ask questions. Please write in your questions in the chat section. And please let me know if you're not able to write questions. And to cover these, we have with us today Mr. Bal Krishn Birla, engineer from IIT Kanpur, who has done a course on behavioral finance and investment decisions from IIM Ahmedabad. He is a senior entrepreneur in food, artificial intelligence, music, and technology. And he teaches taxes to kids and also to grown-ups. He's also an avid investor. So welcome to the show.
Thank you.
Alongside, we have Nitin. He's a graduate from IIT Prayagraj, and he has over 16 years of software industry experience. And he is passionate about money savings and tax savings whenever and wherever possible. So welcome to the show as well.
Thank you.
So without any delay, let us start the session. Bilaji, over to you.
Thanks a lot, and thanks for this opportunity. So let's make it interactive. I think tax is something which is, am I audible? Am I visible?
Yes, we can hear you and we can see you, sir.
Perfect. So let's get started on the topic. I think saving taxes is something which is dear to most of us. You know, you might have heard an old statement that color of the money is the same, but actually it's not the same. The satisfaction you get out of the money you save on tax is greater than saving from somewhere else. So let's talk, let's dig deep into it, into the topic. And yeah, as I was telling, that I have my colleague Nitin, and he's passionate about saving money in multiple places, so he'll also pitch in wherever needed. So let's just start. What is tax really, right? I know this is a satirical take on the issue, that political promise today. So a lot of us hear finally tax is nothing but something which government takes from you for the greater good of the nation. And sometimes this greater good of the nation obviously comes as a political promise. So if your politician is making a promise to you about something which is going to happen, probably that's a tax waiting for you. So that's the overall context of the text. And now let's just dig in. Yeah, I think brief introduction, we have talked about it. So I'll just skip this. So let's just start with some of the basic things so that I set the background for this. So first, let us understand, my assumption here is that most of you are salaried individuals. So what I have tried to do is just overall few things I would like to talk about is that we have assumed that most of us are primarily salaried individuals. So most of our salary, primarily source of salary is, primary source of income is salary from a company. And the other thing which I am assuming here is most of the data which I am presenting here, I have updated it for the latest budget because the budget has changed. So rules might be slightly similar if you are filing a tax return, because after the budget things have changed. But we thought it might be better for us to be consistent across. So most of the data we'll be presenting is after the recent budget, right? So let's first talk about what is the source of income tax information, right? Income and tax information. So one of the basic sources is basically a Form 16. So every employer at the end of the financial year basically gives you something called as Form 16. And Form 16 basically gives a summary of, so let's say the financial year gets over in March. So typically you will get it in April or May from your employer. And this will give you a summary of all the salary you have received from your employer. And it will also list out, since what happens in our case of our salary from employer is that employer actually pays some tax to the government. So all those details are also basically indicated in the Form 16. So that is one document which you will get primarily from your employer. Next two documents which are important in terms of your earning is primarily something called as AIS or 26AS. So AIS is nothing but, so you should go to income tax portal and register there. So it's a very simple, easy online process that you can register using your PAN. And then you get access to what is, how does income tax department view your entire salary as. So AIS is an income statement, annual income statement, which you can see basically on the income tax portal. And this is a great place for you to just confirm. So what you should normally do is, you should just cross check. Normally your Form 16 and AIS should be matching, right? So this is one way to just cross check that the salary which your employer is saying has been given to you, that is the same thing which is reflected in the AIS. And another form or data which is available on the income tax website is something called as 26AS. This basically gives you all the details of taxes which have been deducted for you. So for example, let's say your salary is 1 lakh rupee per month. Now what will happen is that your employer, based on the deductions or based on whatever income tax calculation, might give you 75,000 in hand and deposit 25,000 rupees in directly to the tax department. So 26AS will tell you in an itemized format that this 25,000 has been already accounted as tax against your PAN, right? So this is another important document which you should just cross check. The third important thing is that a lot of us nowadays have become investors in stock market, especially after Corona. I think a lot of people have jumped into the stock market in various ways. So you will typically have a capital gain report from your broker. So either you are a mutual fund investor or you are a stock investor, your whatever tool you are using, they will have a tax report which they will give you. And most of these things are online nowadays, so it's not that you have to go anywhere to get a physical copy of this. Form 16 is sent digitally by most of the employers. AIS 26AS is available online. Capital gain reports basically is something which is available from your broker. So you should just log into your broker site. It will have some section on reports, and there you can generate this. So hope this is clear, and I'm giving a simple example, which is these are the typical things which will be there for a simple scenario. Obviously, there can be more complications that you might have income from a property you sold, you might have income from gold you sold, or some other things as well, right? You might have received a gift from somebody. So we are not going into all those complications right now, because I think this covers these so income sources basically cover most of the scenarios which we have. By the way, I can't see the chat window here. So if there is any question on the chat, please somebody just point it out to me.
I'm looking into it, Billaji. So I'll update you if we get a chat.
Sure. So let's talk about, so first things first, our session is all not about evading taxes. It is about saving taxes. Tax evasion is a very different thing, and I'm sure you would have read in media about different people who have evaded taxes and ran off to some other place, all that stuff. We are not talking about all that stuff. What we are talking about is, so yeah, tax evasion by definition is illegal act of deliberately avoiding paying taxes. It's normally done by underreporting income or inflating deduction, not filing returns. And obviously that's a legal offense, and that's not what we are talking about here. All the techniques which we are talking about are basically legal techniques which are available to every taxpayer in the Income Tax Act. So our focus will be on legal methods, and then we will be figuring out how we can use deductions, exemptions, and tax saving instruments to save taxes. So let's talk a little bit about various ITR forms. So basically what happens is that when you are filing your income tax returns, there are different types of forms you can fill, and this is not a complete list. I'm just talking about first three forms, which cover most of the salaried employees. Uh, so ITR1 is the simplest form, uh, and form you should look at. It's not like an offline form anymore. It's all online. So what happens is when you are filing returns online, if you choose ITR1, then what happens is that only those questions will be asked which are relevant to ITR1, uh, and same holds for ITR2 and ITR3. These are just different forms which the income tax department has, and it is based on what are your sources of income. So if so ITR1 is the simplest one. If you primarily have salary income, one house property, and interest, bank interest comes for most of us in some form, right? You'll have a savings bank account, some money will come. So if you have that, then I think you can just go ahead with ITR1. It will be a simpler form. It will not have any complexities. ITR2 is if you have some other income coming from capital gains. What it means is if you have invested in stocks, mutual funds, and you have sold those stocks, mutual funds. By the way, just wanted to point out one thing is stocks and mutual funds might have, so for example, let's say you bought a stock for 1 lakh rupees and it became 1,50,000. You haven't realized the gain till you sell the stock. So you will get capital gain income only if you sell the stock. If you just have it in your account, that is still not your income. That is just in your demat account, right? So ITR2 is if you get capital gain. ITR3 you move to if you are into, so typical way, if you have some business income, and business income can come from, if let's say you have a side business running, or if you have sometimes a lot of people do trading in the stock market. So that also is counted as business income. So in that case, the return you have to file is ITR3. Now let's talk about two regimes. So historically, what has happened in the Indian taxation system is that we have had a very elaborate system for getting exemptions for various things, right? So earlier the tax regime was primarily that, let's say you have a salary of 100 rupees. Now it's not that you have to pay the let's say the tax rate is 20%. It doesn't mean that tax is directly 20 rupees on that 100. What happens is that there is an elaborate scheme where you can get different types of deductions for different things, right? So old tax regime is so historically Indian tax system has been that there were tons of varieties of different types of deductions which were possible, and so filing a tax return was fairly complicated. I'm sure a lot of you would have given these proofs, investment proofs, and things like that to HR. So what they have done is they have launched a new tax regime, and this is more a recent development, uh, where a lot of these deductions are basically removed, right? So but the government didn't want to remove the old tax regime, so they still have they give you an option that you can either choose the old tax regime, which will have a lot of different types of deduction, or move to the new regime, which will have relatively less options for the deduction. uh, one more thing which I'll just point out here is government is trying to move everybody to the new tax regime. So government's focus is that, and this has happened quite quickly in past, I would say 4 or 5 years, that like for example, now if you don't choose a scheme, you will be defaulted to the new regime. So a lot of these changes have happened in the recent past because there is an effort from the government side to basically simplify taxation, and new tax regime is primarily an effort in that direction. Obviously, as a taxpayer, you should look at what is good for me, and that is the new tax regime good for you or the old tax regime good for you? That is a complicated answer. We'll try to answer it in a way, but that is a calculation which you might have to do. And you can obviously guess that what happens is that since the old regime requires a lot of investment proofs and those kind of things, it becomes more complicated, more documentation for that. New tax regime becomes easier for you to file taxes. Let's talk a little bit about what is in old regime. And so old regime is up to 2.5 lakhs nil tax, 2.5 lakh to 5 lakh 5%, 5 to 10 is 20, and above 10 lakh is 30%. Right? That is roughly the slabs. And even in the recent budget, they haven't changed these slabs. These slabs have been constant for some time. Now all the changes they are making are primarily in the new regime. These are the new regime charges, the new regime tax rates. Basically up to 3 lakh is nil, 3 lakh to 7 lakh is 5%, 7 to 10 is 10, 10 to 12 is 15, and 12 to 15 is 20%, 10 to 12 is 15, and above 15 lakh it is 30%. So these are the new ranges which are applicable from this financial year. For your last, I think they have, Nitin, correct me if I'm wrong, they have introduced extra slab this time, right, Nitin?
No, it's just means they've added extended some slabs like 5% slab is extended by 1 lakh, and then the 10% slab is also extended by 1 lakh. That's it.
Right. So there are minor changes in the slabs they have made in the recent budget. If you are filing last year tax returns, there might be a slight difference from this. This will be valid for your next tax return. Now let's talk about new versus old is a question everybody has in their mind. So we have just tried to make a table which gives you a rough idea. Doing exact calculations for somebody. So overall guiding principle is this. Based on the salary you have, there are different deductions you can claim. So what happens in the case of income tax is, let's say you have 10 lakh salary, and now what you do is that you can get a deduction of, let's say, 2 lakh. So what happens is your salary, taxable salary becomes 10 lakh minus 2 lakh. That makes it 8 lakh. And you will be taxed only on the 8 lakh, not on the 10 lakh. Now, there are different types of deductions you can get basically in the old scheme or in the new scheme, right? So what happens is that if your deductions are too high, that is the only way you can save a reasonable amount of tax. So this table basically outlines a break-even point. So let's take one example that at 7.75 lakh, if you have, in the old scheme, basically, if you have 3.25 lakh as deduction, then you can actually claim zero tax. And these deductions basically include the standard deduction. Standard deduction is nothing but an amount defined by government. So earlier it used to be, last financial year it was 50,000 rupees. Now it has been increased to 75,000 rupees. So what will happen is that 7.75 lakh, 75,000 will be removed. So it becomes 7 lakh. And then the tax calculation happen on 7 lakhs. If you have different types of deductions you are using, and we will talk about those deduction in this presentation. So if you can have deductions up to 3.25 lakh, you will be equal, right? If your deductions are less, then your basically new regime will work out better. So this amount of deductions you have to invest in, that is something which is different for different tax slabs. So if you are at around 10 lakhs, this minimum deductions which basically become is around 3,50,000. And if you, as you go down, obviously this amount of deductions you have to claim. And look, in this table we are also talking about, so this is the break-even point between the old and the new regime. So if your deductions are less than this, you should go to the new regime. If your deductions are more or equal to this, then you should stick to old regime. So this is more a guiding principle. Obviously, you can do actual calculation and fill in data related to actual deduction and see what is works out better for you, old or new. And then obviously you also have to look at how much hassle it is for you to maintain all those proof of investment and things like that. And just one more thing I would like to point out here is that a lot of these deductions are claimed on things which are stuck for a long term. So some of us have a family structure where our expenses are very low. So in that case, so just to give you an example, one of the deduction you can claim is if you invest in equity linked savings scheme in mutual funds. Now that money is locked for 3 years. Now you might have a family structure where you don't mind that money being locked for 3 years. So you might invest in that and and keep it that way, right? But some of you might have where you need more in-hand salary right now because you have expenses which you have right now. So in that case, that might be a better tax saving option for you. But from a practicality perspective, it might not work out for you, right? So you have to look at your family situation, your expense structure at your home and make a call based on that. It's nice to save taxes, but obviously it cannot happen at the cost of your day-to-day operations of your family as well, right? Now let's talk a little bit about capital gain. In fact, this is something which has changed in the, a lot of changes have happened in the recent past. So broadly, two asset types, equity and debt. Equity is obviously your stocks or the stock equity related mutual funds. So in capital gain, what happens is there is a long-term capital gain, there is a short-term capital gain. So what happens is if you hold any stock for greater than 1 year, it is counted as long-term capital gain. And if it is less than 1 year, it is counted as short-term capital gain. So let's say if you had a stock worth 1 lakh rupees and it became 1,50,000 and you sold it within 1 year, then what will happen is that 50,000 is taxable. And as per the short-term capital gain, your tax will be 20%. So 50,000, 20% becomes 10,000 rupees. But let's say if you were sold it after 1 year, then 50,000 will be taxed at 12.5%. Now these percentages have increased again in this financial year, in this budget. It used to be 10% and 15% earlier. Now it is 12.5 and 20%, right? There is one thing which you should remember in capital gain is that there is a tax relief up to earlier it was the last financial year, it was basically 1 lakh rupees. So let's say if your overall capital gain in a financial year was, let's say 1.5 lakh, 1 lakh is not taxed. Whatever is beyond 1 lakh, that will get taxed, right? Now this 1 lakh has been made 1.25 lakhs. So let's say you had a capital gain, let's say you had a long-term capital gain of 1,50,000 rupees, let's say in the current financial year, then what will happen is that out of 1,50,000, 1.25 lakh will be removed and you will be charged tax only on the remaining 25,000 rupees. And how to use this for tax saving is something we will talk about tax harvesting a little later. And then the second type of thing is debt. Basically, you can buy debt mutual funds or now what has happened with debt is that they are basically charged at your slab rate. So after from your salary, when you remove all the deductions, you are basically in a particular income tax slab. Like we talked about the income tax slabs earlier, right? So this will be added to your regular income and you will be charged at whatever that income tax charge is for that. So this is something which has changed recently. Earlier, what used to happen was there was something called as indexation benefit. I'll just explain indexation benefit a little bit. And this used to work earlier and this has been removed now. And it's important to understand for you to understand what is the implication of this. And this is true not just for debt, it is also true for property as well. So earlier indexation used to work something like this. Let's take example of a property, for example, right? So let's say you bought a flat worth 100 rupees somewhere. I'm just giving hypothetical numbers here. So let's say you bought a flat worth 100 rupees. Now, after 1 year, the worth of that flat has become 110 rupees. And then the inflation in your country, in your society is basically, let's say 6%. So what happens now is that your gain is 100 rupees have become 110. So 110 minus 100 becomes 10. So you will think that you will be charged tax on 10 rupees. But with indexation benefits, what happens is, let us say there is a 6% inflation. So what happens is, let's say you invested 100 rupees right now. Now that becomes 100 plus 6, 106 rupees. So your real gain is basically 110 minus 106, which is 4 rupees. Now you will be charged tax on pretty much just 4 rupees. So that used to reduce your tax liability because the inflation was accounted. Now the inflation, now this inflation accounting is totally gone from the from different asset classes. Government is basically exiting that regime, but earlier it used to work. So debt, you can pretty much, so earlier what used to happen was that debt mutual funds used to have indexation benefit, but now that is removed and they are pretty much at par with fixed deposits. So if you are doing a bank fixed deposit or you are doing a debt mutual fund, from a taxation perspective, they are roughly similar. Anything to add on this, Nitin? Nitin, you are not audible. If
Yeah. So yeah, that I think that covers pretty much the changes which have been done recently in the budget. So.
Now let's talk a little bit about salary is not equal to income. Look, that is something which you should understand, that a lot of us make assumption that if my salary is 1 lakh a month, then that is the salary and income are different things. From a salary is what your employer gives you. Income, final income is after all the deductions have been removed. So if your employer is giving you 1 lakh a month, doesn't mean that you have to pay tax on that entire 1 lakh. There are different types of deductions and exemptions which are possible. So salary is not equal to income as far as in the taxation world. There are primarily three ways, and there are minor differences between the three which are there. That there are deductions, there are exemptions, and then there is a rebate. So exemption is pretty much, some type of things are basically they are free, tax free in the hands of the taxpayer. So for example, to give you an example, let's say your income is agricultural income. So in India, agricultural income is exempted from tax. So it doesn't matter if you are a farmer, if you are making any income via agriculture, there is no taxation which is possible on that, right? So it is totally exempted. Or let's say you are getting scholarship money, right? So that is something which is basically excluded from the tax calculation altogether. So there are different types of exemptions which are there. Now there are tax deductions. So deductions are basically which makes reduce your taxable income. So just to give you an example, like we talked about a deduction which is called as standard deduction, which used to be 50,000 and now 75,000. So let's say last financial year when it was 50,000. So let's say your salary from your employer is 10 lakh. So what will happen is standard deduction is applicable to everybody. So what will happen is you will minus 50,000 from that, and your effective taxable income will become 9,50,000. And now you'll do all the calculation using 9,50,000, not 10 lakh, right? So deductions are a great way for you to save tax. Again, what deductions you can claim is different for new regime and old regime. Then the third concept is a tax rebate. Like, for example, there is something called as 87A tax rebate. The overall idea is that government, if your salary is relatively very low, even if the tax calculation show you some tax, government says, yeah, below this salary structure, I don't really want to tax you. So government might give you a rebate, using which your tax liability might reduce or might become zero. So these are three different concepts which are there, which pretty much work on making your tax liability less. Now let's talk about these sections. You don't have to remember these numbers. There are tons of these numbers, and I have talked about sections which are more popular. I haven't really talked about, look, this list is pretty long, number of sections. Look, one thing overall I just want to tell you in the taxation context is, and especially for most of us who are salaried employees, overall tax structure is fairly complicated, but what is applicable to you can be very simple. So if your primary income is salary income and capital gain, which is true for most of us, or let's say plus rental income from somewhere, that covers 99% of the people, right? At least in our social circle, right? So that part can be very simple. It's not necessary. So for example, there is a section which talks about political donations. You don't need to understand it. I'm guessing that none of you is giving donating money to political parties, right? So here I'm talking about some basic sections which apply to most of us. Look, in the section and wherever I have put a star, it means that that is applicable to the new tax regime as well, right? So one of the sections which is important for you is basically 24, interest on home loan. There are some complexities related to your self-occupied home versus rented home. Nitin, can you elaborate a little bit on that, on the section 24 thing?
Yeah. So the idea here is to give you a maximum of 2 lakh benefit on the home loan. But and this 2 lakh benefit on a home loan is available for old regime. But under the new regime, there is a condition that this is only applicable if that particular property is rented out. So you can deduct this amount from the rent received, and the final amount you can claim. So that is one part of section 24. The other part is if you have two properties which are having a home loan, then you can claim the benefit for both. But the maximum claim that you can take for a single property means the claim on the interest on the home loan is 2 lakhs per property, and overall in a year you can only claim 2 lakhs. So what it sums down to is that you can show both your properties, show interest on both your properties, and whatever is the interest, it will give you a cap of 2 lakhs on per property. And finally, if your total calculation for that particular year's income tax return is more than 2 lakh, then it will just take 2 lakh and rest of it will be forwarded to next year's. Like there's a concept of carrying forward your losses to future years, which in future, if you have gains from the same category, then you can offset those from the losses against losses which you have already accumulated over the same category over the past 8 years. So this carrying forward of losses is one concept which is useful if you have multiple properties. So yeah, that is about section 24. Means I'm sure in most cases it will be a single home loan running for self-occupied property, or if it is for a let-out property, then you can you can use this interest on home loan benefit for even for the new regime. But if it is a self-occupied property, it's not available for the new regime.
Got you. And then there is all this sections 80C, 80CCC, CCD1. So this is basically typically used by most of us, which is for doing your LIC premiums, for doing equity linked mutual funds, equity saving mutual funds, or the principal part of your home loan. The only thing is that all this can add up max to 1.5 lakh. So even if you have, let's say all this adds up to, let's say 2 lakhs for you, only 1.5 lakh is the max, which will be counted here. And for your home loan, you can always, for the last financial year, you can get a certificate from your, I think there's a process a lot of you might be doing, that you get a certificate from your home loan company that what was the amount of interest I paid last financial year, what was the principal I paid, right? That is a certificate which all of these companies give. Then the next section is 80CCD 1B. This is again a relatively more recent thing, which is basically you can open an NPS account, a National Pension Scheme account. And by the way, this can be done by private employees also. Earlier, this was limited to government, but now it is open to private employees also. NPS, you can basically contribute up to 50,000 rupees, and that will be again, exempted from tax. Theoretically, you can add up these three numbers: 2 lakh, 1.5 lakh, 50,000. At least 4 lakh is a deduction which you can get here. But again, this 80cc, 80ccd, all these things are not applicable to the new regime. So this is applicable, section 24 is applicable to both old and new, but other things which we are talking about is not applicable to the new regime. The next scheme is basically 80CCD2, which is NPS, employer contribution. So what happens is that in NPS, you can have a contribution from employee as well as the employer. Unfortunately, in the private companies, I have not seen too many employers opting for that. This is something which I have seen happening in more in PSUs, where employer also contributes. And what happens is that this 80CCD2 an employer contribution to NPS, that is not taxed basically for in the old regime as well as new regime. So if you can negotiate with your employer to give part of the salary as NPS contribution. Look, what happens with NPS contribution and things like this is, and this is a practical problem for employers as well, that most of the employees compare things on what is in-hand salary. Now what happens is NPS is something which gets locked till you are 60. So it is primarily for retirement planning. So our in-hand comes down due to this, right? So a lot of the people, especially in the private companies, don't make this as part of your salary from that perspective, because potential employees will compare in-hand salary and will assume that I am getting paid less. Then there are a few more things like interest from savings account. These kind of things you don't even need to calculate. Nowadays, I was talking about all that AIS, 26AS, these are auto-populated by the income tax department. Then there is 80D, which is basically medical insurance, self, spouse, kids, and there are some complications if your parents are less than 60, greater than 60. So this is another option. And then there is 80G, which is basically you can give donations. But look, all these things are applicable only on the old regime, not in the new regime, right? And then there is a LTA. This is something which most of us miss out on taking this exemption. Here, you can basically take twice in 4 years. There is a I think 4-year windows which run, and within one window you can take it twice. And this typically covers, Nitin, it's the economy class flight tickets, right? Roughly that is what is covered, right?
Yeah, and the travel should not be outside India.
Yeah, so within India, if you are traveling, the economy class tickets basically are covered, and this can basically include your family also. So let's say if you are flying from Bangalore to Goa and with family, that entire thing you can basically take an exemption on that.
Yeah, so only travel cost is covered, not the hotel cost, and all those things are not covered.
Right. So I think train or flight tickets,
flight cabs, those are the bills you can attach. And this generally happens, this usually is done through employer only. So you have to have a LTA component as a part of your salary structure. Then you have to have a leave approved from your employer, and those should be the days where you're traveling, and those should be the bills you should be submitting to your employer. So yeah, Means if it is through all the official channels, then it will anyways be included in your Form 16. So you just need to submit the bills and your employer will help you out in these things. You just need to give those bills to your employer and it will come in your Form 16.
Right. And in 80D also, Nitin, there were some complexities, right? Whose insurance you can claim insurance, and I think medical
So
checkups.
80D has two different parts to it. One part is the medical insurance, and then there is a preventive health checkup. So overall limits which are specified here are 25,000 for the self and family, and additional 50,000 if parents are over 60 years of age. So that are the overall limits, but within that there's a sublimit on the preventive health checkup part. So a max of 5,000 is what is applicable if you are claiming a preventive health checkup. So if you are going for a full body checkup, that usually is between something between 2,000 to 8,000 rupees is these guys package that is. So if you are paying them from your own pocket, then you can of course claim them. But the maximum on that is 5,000, which is within this 25,000 limit. So that is one part. And for senior citizen parents, you have an additional option to cover medical expenses if those expenses are not covered by any insurance. So you can have a claim of medical expenses up to 25,000, which is within the overall limit of 80D.
Got it. But all of them are available only if you are in the old regime, right?
Yeah, so all these sections 80TTA, 80D, 80G, LTA, all these sections are not applicable under new tax regime.
Got it. So I guess these are the primary sections which are applicable to most of us. This list is too long, and political donations, and then there is a disability related expense, and tons of other sections which you probably are not applicable for 99% of us, right? So we are just covering about these deductions and exemptions. Now let's talk a little bit about salary structure. Look, this is something which obviously varies company to company and HR to HR, admins to admins. So what happens is that your salary structure can basically change your tax liability quite a lot. And this is a discussion you should have with your HR whenever you are joining somewhere, because and I think the typical things are that HRA, if you can claim HRA, obviously that is something which is useful. Then if you are getting multiple allowances, there are allowances like uniform allowance and travel allowance. One of the best ways for you to look, there's a difference between company taxation and personal taxation. What happens in a company taxation is, so let's say a company makes 100 rupees, right? Then what it will do is it will show expenses of 80 rupees and it will be taxed only on the 20 rupees, right? That's how taxation works for companies. Individual taxation is very different. You get a salary of 100 rupees. You can't tell the tax department I spent 10,000 on Swiggy Zomato and then I spent 10,000 on Book My Show. So tax me only on the remaining 80 rupees. You can't do that, right? So what happens is that if your company can give you reimbursements, that is something which is a direct tax saving for you. So if the company says, I'll reimburse you for your commute cost to office, I'll reimburse you for internet you take at home, for your mobile bill or whatever other expenses which are there, right? So then that is pretty useful for you as an employee, that you get basically a tax relief that way, right? NPS contribution, I think we were talking about it. If your company can give you part of your salary as NPS contribution, that is also useful for you, although that money gets locked for you for your retirement. That is the only side effect, but from a tax perspective, that's quite efficient. Another thing which I think, Nitin, you use quite a lot is I think companies give a car lease. I think you can tell more about how this works, Nitin.
Yeah, so car lease, actually there are multiple ways in which companies structure the car lease. So and they, of course, they get a benefit in their own taxation also through this. So it's not just that they are giving you this to you as an additional benefit. They are also claiming benefit on top of this. So of course the companies have multiple like reasons to give you this if they have any card lease policy. So the how it works is means if you have a car lease, I mean, so usually the best scenario where it works is if you have a car lease policy from your company, then the salary which is given to you, uh, the amount of lease or the the installment of the lease which is deducted every month is deducted before coming into your hand. So that never becomes a part of your income. So that never becomes taxable. So that's the main benefit which personally what I have seen in my car lease policy is that's the main benefit which I get. So if I'm paying around 15,000 rupees per month towards my car lease, so that 15,000 never enters my taxable income, and that saves me a direct 4,500 rupees 500 rupees per month if I'm in a 30% bracket, right? So this works really well.
So in this case, basically the company buys the car for you and gives it to you, right?
Yeah. So the problem with this thing is the car is not in your name; it is in company's name. You are assigned as a user of the car. So and car lease is not something which a small company will be able to provide because there is a lot of admin work involved in that. There is a separate leasing company which which your employer will be tied up to, and they will manage your fleet and all those things. So yeah, it's not something which a small company will be able to provide you.
Right. But it's a useful thing, right? A lot of us need a vehicle, and this type of model can be developed, which basically saves your tax from an employee perspective.
Yeah.
Now, I think this is something which Nitin was talking about, that there is a concept of carrying forward losses. So let us say you have a loss, and loss here we are talking about different types of loss. I think interest payment on housing is also counted as a loss, right, Nitin?
Yeah, so interest payment loss can be set off in the same year if it is up to 2 lakhs. But if it is more than 2 lakhs, then there's an option to carry forward that extra loss to future years.
So for example, if let's say in one financial year, I paid 3 lakh as interest, and then I could claim only 2 lakh out of that in this tax
Yeah,
return.
but at one particular property, you can anyways only have 2 lakhs interest claimed. So it will not work for that.
Got it.
So if you are claiming that 2 lakhs this year, then it will not go to the rest of the 1 lakh will not be going towards or carrying forward of losses, because at a property level that is topped up, means capped at 2 lakhs.
Got it. So this same thing applies for, so in fact, offsetting losses is one way to reduce your tax liability in terms of stock market as well. And we'll talk a little bit about it, I think, in few slides as well, which is basically related to harvesting. So there are two types of harvesting. One is basically a tax loss harvesting. So if I go to the last thing, I'll just explain the two types of harvesting. So what happens is, let's say you have a stock which is running in loss. You have, let's say you bought it for 1 lakh and now the value is 50,000, right? So what you can do is you sell the stock, and you don't want to sell it. You still feel that long term this stock will come back. So what you do is, let's say I sell the stock right now, right? Today I sell the stock in a loss of 50,000. And then I buy it again tomorrow. I'll buy it again tomorrow, and let's say it's still available at 50,000. Now what happens is, in the current financial year, I have incurred a loss of 50,000 rupees. Now from overall taxable income, whatever I have capital gain, let's say you had some other capital gain of 1 lakh rupees. Out of that, and assuming it's both are long term, what will happen is that, let's say you had 1 lakh capital gain somewhere, and now you booked this loss of 50,000. Your taxable income will become 1 lakh minus 50,000, right? And if let's say I book the lock, if I sell the stock today and buy it again tomorrow, it's not that I'm stopping to hold the, hold that stock. I'm still holding the stock, but just by doing this, so this is called as tax loss harvesting. And this is used in another context, and let me explain you in terms of, so we were talking about this, right? Capital gain up to 1.25 lakh, long-term capital gain is basically tax exempted, right? So up to 1.25 lakh. So every year you have this 1.25 lakh limit. So sometimes it's easier to use this limit. So let's take an example. where let's say I buy a stock today for 1 lakh rupees. I wait for 5 years, and let's make an assumption that every year this stock is growing by 1 lakh. So 1 lakh becomes 2 lakh in the next year, 3 lakh in the next year, 4 lakh, and then 5 lakh. Now let's say after 5 years you sell it. So your capital gain is you bought it for 1 lakh and you are selling it for 5 lakh. So 5 minus 1, 4 lakh is your gain. And so what will happen is out of that 4 lakh, 1.25 lakh will get deducted, and the remaining amount, which is basically 2.75, right? That is what you will pay tax on, right? So 2.75, and then it's a long-term capital gain. It will come to around whatever 35,000, something like that. You will pay tax in this scenario. But there is a different way to do this. Let's say you bought this stock for 1 lakh. It became 2 lakh next year. Now what you do is you sell this stock for 2 lakh and then immediately buy the next day, right? Stock or mutual fund, it works for both ways. Now you have booked a capital gain of 1 lakh. Or it means you can claim up to 1.25 lakh because this limit has been changed to 1.25 lakh in this budget. So now you can continue to book this loan and book this loss, book this gain basically. And as a result, after 5 years, you have zero tax liability. So tax harvesting is a common technique used by a lot of people to basically save money on this. So basically the idea is that this 1.25 lakh long-term capital gain tax exemption, this is something which you should certainly use to reduce your overall tax liability. Anything to add on this, Nitin?
No, I think that pretty much covers the harvesting part. Yeah. And the harvesting only works for long-term capital gains, so it's not for the short-term.
Yep. Now, just overall, I think few things which you should always remember is try to fill your tax return yourself. And it's not that tough. I think a lot of us get scared by a lot of these different sections and different things. Is the best scenario is file your tax return yourself. And I think, Nitin, you can comment on this. I think you file using the income tax website directly, right?
Yes.
Is this fairly straightforward? People can do easily, or?
Yeah, so it's pretty straightforward. Means if you don't have any special type of income to report, then I think ITR 1, ITR 2, I've been using the direct website for past 16 years. I've done my returns for 16 years. I've done my father's return for more than 6 years. My wife's return for more than 10 years. So I've done. I must have filed more than 50 returns till now.
Okay.
So it's a pretty straightforward process. If you know the numbers, then there are no surprises for you. Yeah.
And my assumption is that over the time, this has become much simpler.
Yeah. So over the time, first of all, the tax website, income tax website, has a direct option to fill it as an HTML form. Means earlier we used to download a Java utility and then fill the numbers in that and take out a JSON export from there and then import it on the website. So that was the earlier behavior. But one part is that is simplified to a direct form filling on the website. There's no separate utility required. The second part is after the AIS. So now the income tax department has come up with the concept of AIS. So all your income which is reported by anyone is part of AIS. So you already know what are the numbers. Like earlier, what I used to do is I used to download all my four bank account statements, mark what were the interest income in them, what were the dividend incomes in them, and then used to manually take out those numbers. Now AIS give me those numbers directly. I don't need to go to my bank account statement at all. So yeah, the process has simplified a lot, and means it makes more sense to take more control of your money, take more control of your taxes, and bring all this under your scrutiny. Means giving it to someone is still means it simplifies your process, but you will never know what is happening with your money.
Right. So I think the first option is file it yourself using income tax website. If you are a little lazier, you want to use, there are tons of tools like Clear Tax, Tax Buddy, those kind of things. That is the second option. The third option is you hire a CA or somebody else to file tax return. But even in that case, you should understand your tax returns very clearly. And nowadays, everything
So a
gets
CA who is asking you very few questions is not a good CA. If he's not asking you for details, then probably he's missing out on reporting some parts of your income, or he's missing out on claiming some exemptions.
right.
And so if the CA is not knowing what all components of your income are present, or what all components of your tax savings are present, then probably he'll miss out on those things while filing the return. So yeah, means even if you are filing from a CA, you need to make sure that you provide all the information available with you to the CA.
Right. Yeah, second thing is file tax returns on time. And right now we are just at the edge. Don't think about tax planning is a continuous process. So what happens is that most of the even companies who sell these tax saving bonds, they do much more business in Jan, Feb, March, right? You will see more ads and everything, but tax planning is a continuous thing. So right now, for this financial year, start thinking of tax planning right away. Don't wait till Feb or March. Whatever you want to do, you want to take new regime, old regime, or whatever, plan that right away. Once you are done with your last year tax, not in July maybe, but in August at least, you should do that planning right away. Income tax website we talked about. Other thing is pay advance tax if capital gain amount is high. What happens is that your employer might not know what stocks you are buying, selling, all that stuff. So you might have a capital gain coming from that. And every quarter you should pay, and you can go directly to the income tax website and pay advance tax directly. And that's fairly straightforward to do. It's integrated with the internet banking of most of the banks, and you can directly pay the tax there. Otherwise, what will happen is if that tax is not paid every quarter, you will be charged some penalty at the end of financial year, and unnecessarily you will be paying that. Verify 26 AS and AIS on IT portal. That's again important for you to just confirm what your understanding of your incoming money is. Check on salary structuring options with your employers that we have talked about. So this is pretty much what I had in my content. I'll be happy to take questions if any.
Yes, we have a few questions, Birlaji. It's in the Q&A section, so I can take it one by one. We have 11 questions to be precise.
Okay.
So I'm taking the questions one by one. The first question is, are there any deductions or exemptions available that could reduce my capital gains tax liability?
Capital gains. Okay. So there is a 1.25, 1 lakh basically deduction, which is there on long-term capital gain, which has now been made 1.25 lakh. So that is something which you can, take advantage of. And as we were talking about harvesting also, that is again something which you can do every year to basically reduce your tax liability. Nitin, anything else on that?
Yeah, so you can use if you have any carried forward losses, you can utilize those to offset your gains. Or and once that is done, after that there's a 1.25 lakh limit for the long term capital gains, which are not taxable. Those are exempt. Initial 1.25 is exempt. Beyond that, it will be taxable. So yeah. So these are anyways, capital gains are not taxed at your slab rate. These are taxed at a special rate. 12.5 for the long term, and 20% for the short term capital gains, right? So these are the only exemptions available. Means the other types of exemption are not applicable to this.
Right. And try not to sell any asset within 1 year. Means I think you should pay only long term capital gain. Try not to pay short term capital gain. That is another way to pay less taxes. And obviously, a lot of assets grow much better if you hold them for a longer term.
Yeah, so one exception to that is if you have already booked some loss in a particular year for a short term loss, then you can think about harvesting that within the same year, or probably move it to the future years.
Okay.
All right. Thank you. I'll be taking up the next question. We have Shamli Singh who's asked, my question is whether interest on housing loan for self-occupied property is set off with salary income, and if not, whether housing loan for let out property is a deduction available.
Nitin, I'll pass on that to you.
I'm sorry, can you repeat the question?
Yes, it says my question is whether interest on housing loan for self-occupied property is set off with salary income, and if not, whether housing loan for the let out property is the deduction available. You can see this question in Q&A section, Nitin. You can see it yourself as well.
Yeah, I can see that. Yeah.
It's
Yeah,
asked by
so
Shamli Singh.
interest on housing loan for self-occupied property is a deduction which you can claim if you are under the old tax regime. So means any income from your salary or anyways means a final total calculation of your total taxable income, this deduction will be applied on top of that. So even if it is not a salary income and any other income, like a dividend income or interest income, or probably if you are having any other income, so that this exemption will be available to you.
Right. Thanks, Nitin. And we have one more question from Bhagirath. The question is, what is the exemption limit of LTA?
So exemption limit on LTA depends upon your. So there's a concept of basic salary, and then there's a maximum percentage of basic which can be given to you as an allowance of LTA in your salary structure. So I'm not having that number right now in means ready, but yeah, that is a percentage of your basic pay, and that has to be part of your again means that has to be part of your salary structure. LTA component should be there in your salary structure. So probably your employer will means if you ask your employer to provide you an LT allowance, they'll be able to means provide you the maximum benefit in that.
Hmm. All right. Thanks, Nitin. We have a question from Ranjit Shekhar. He asks, what are the chances that equity LTCG are taxed according to slab rates, since debt already is taxed according to this slab rates?
This discussion is actually happening a lot in stock market. In fact,
Okay.
recently the financial, I think yesterday some financial secretary said, yeah, in the long run. So this can happen, but I don't think they can make it happen immediately. I think it'll be bad for the stock market if this happens. But yeah, there have been a lot of murmurs happening in the world, in the stock market, that they might do this and they are moving in that direction.
Hmm. All
Yeah.
right. Thanks, Bilaji. And we have a question from Pradeep Sinha. Can you please provide a short summary of the new tax regime deduction or ideas of tax planning, like let out home loan interest, NPS, etc.?
So Nitin, in the new regime, I think we're talking about new regime here. I think the primary big deductions will be the house related stuff, right? House interest.
Yeah, so I think if we are going towards new regime, anyways, the target of the government is that they want to simplify the whole taxation process. So most of the people they want to move towards a new regime, and they want that deductions part to be out of this. So sooner or later, it is anyways going to go away. But for now, right now, the available deductions under new tax regime are one is the interest offsetting against the rental income for let out property, and the NPS contribution of employer. And the NPS contribution of employer again is a component which has to be part of your means has to come from your employer. So that is not something which is available to everyone. Like I don't have that option at my employer. So again, yeah, that is something which might or might not stay for long. We can't say that, but yeah. So those are the only deductions on top of the standard deduction which is available. So standard deductions they have recently raised to 75,000, and so if you are having a annual income of 17 lakhs, 75,000 you can deduct from that, and rest directly goes towards your slab rates. That is how new tax regime will work for most individuals.
Okay. Thanks, Nitin. Thanks for that. Just checking if I missed out on any questions. We have a question from Bani as well. How can one avoid paying any income tax on an annual salary of 12 lakh rupees? Uh, I want to know through expert calculations.
That
Yeah,
we should.
so there was a slide which talked about the new regime, old regime, right? So I think at 12 lakh level, the maximum whatever maximum deductions we can claim, if we claim those, that will bring your tax outgo to very low. But I don't think at 12 lakh it would be zero.
Look,
That is something which needs to be calculated actually.
look, there are these presentations. In fact, yesterday I was seeing a video, one guy claiming at 50 lakh, you can pay zero taxes. And these are things people do on YouTube to get click-throughs, right?
Yeah, actually, these are more like a click-through things, because see, if you are having a 12 lakh income and you are trying to claim more than 5 lakh of deductions, that is not something
Practically
which
feasible.
is feasible, right?
Also, the funny thing was, this guy was suggesting out of the 50 lakh you make, you donate 40 lakh to a political party. Now, who will do that, right? So
Yeah.
sometimes a lot of these type of
See, clickbait
yeah.
happens, they just put
Yeah.
any number, any favorite number, and that's a clickbait.
Yeah. So I would rather pay taxes and run my family, right, instead of paying
Yeah.
it to a political party, right?
Yeah, but I think means coming back to the topic, the maximization of deductions, and deductions, when we talk about, it's mostly when we are talking about old tax regime, which is not going to stay for long.
Right.
This year it has become like this year I have filed my taxes under the old tax regime. I'm sure next year when I'm doing my taxes, I probably will need to move to the new tax regime because of these additional benefits in the new tax regime. So yeah, so maximizing deductions under old tax regime is 1.5 under 1.5 lakhs under ATC, 2 lakhs of home loan, then 50,000 of the NPS 80 1B. Then maximize your 80-day deductions, take medical insurance for your parents and all those things you have to do. And apart from that, yeah, there's not much. So until unless you go towards donations, so donations is something which I'm not sure with means, is it actually tax saving or it is for a greater good.
I think your audio is gone.
You're not audible.
Oh, sorry, I was on mute. We have one more question from Ayushi. If I have an annual CTC of 17 lakhs, which tax slab is suitable for me for maximum tax savings?
Yeah, so at 17 lakhs, I think the trigger point will be if you have means apart from the standard deduction, if you have a deduction, if you are able to claim deductions of more than 4.5 lakhs per year, then old tax regime will be better. But otherwise, better to move towards a new tax regime. Slowly it is becoming like a no-brainer. New tax regime is the way forward for 99.9% of the individuals.
I guess I see one more question, 7.75 lakh per year. This is from Manish Kumar.
Yes, at 7.75 lakhs per annum, 75,000 is deducted towards your standard deduction, so it becomes 7 lakh. And 7 lakh, there's no tax on new regime.
Right.
Yeah, so it will become
You
zero.
get a rebate on 87A, so it will be zero.
Okay. So coming back to that question, Nitin, so let's say the annual income is 17 lakhs, and if the individual is not able to show more than 4.5 lakhs of investments in any sort, it is not ideal to go with the new regime. Like, what are you suggesting? I mean, I quite did not.
Yeah. So new regime is better.
New
If you
regime
are
is
not
better.
able to claim 4.5 lakhs
yeah.
deductions, then new regime is better. And it's not just deductions. See, not just investments. For investments, they have made a section 80C where you can claim the investments. Then there's a separate form of investment, which is investing in a proper housing property, right? For that, they have a separate limits of 2 lakhs. Now, these are all distributed into multiple things, and the planning is like elaborate in this. You have to do all that elaborate planning when you are doing this. So that's the reason why I am repeating this again and again, that means coming to that 4.5 lakh number with a low salary of 10 lakhs or 12 lakhs is anyways not going to be possible until unless you are doing something very fishy. which anyways is not the topic of this particular webinar. So yeah, and at 17 lakhs, of course, that is possible. Means with proper planning, it is possible, but depends whether you want to do all those things to claim the maximum deductions, or you just want to simplify your life and get into the new tax regime, which anyways the government is targeting towards that. So probably next year they'll next year, or not, maybe not next year, next to next year, they'll add some more benefits to the new tax regime, which will kill the old tax regime totally.
Okay. Sure. Thanks, Nitin. And we have a question from Harshit Kulashrestha. He says, he asks, can you please tell us about nil tax? How can we file that and what are the benefits?
So when you're talking about nil tax, so can you please unmute this person so I can better understand the question. Nil tax as in nil tax on salary of 5 lakhs or no income.
I think the question is generic. If you could.
Yeah, so there are, means if you have a income up to 7 lakhs or 7.75 as we were seeing, then you can just file your returns, report your income of 7.75 lakhs, do the tax calculations. It will claim the standard deduction of 75,000, claim the 87A, and then your final outcome will be that you have nil tax. So that is the way for any income up to 7.75 lakhs. But yeah, above that also, it can be nil tax if you opt for all those deductions, opt for the old tax regime, and so that is something which you have to carefully plan for. And
I think
it will
within the
require a lot of stress on your finances actually when you do all those investments, all those like if you are planning for a home loan, anyways the at a low salary you can't go for a very big home loan, and if the interest outgo is not more than 2 lakhs, then anyways it is not helpful, right?
Nitin, I guess the question is, my understanding of the question is that let's say if I have less than 7 lakh as salary, should I opt for not even filing a tax return or still file a nil tax return?
True.
Okay. Yeah. So I guess the recommendation on that, I'm not 100% sure about that, but uh, anything above 5 lakh of income has to be means you have to file taxes for that in a regular manner. Under 5 lakh income, there are some separate clauses where you can file nil tax, but that I'm not very sure about that.
I think the other advantage which I can see is of filing returns is if you are booking losses, then you might want to show those losses in the tax return, which you can offset later, right?
Yeah.
So that is another advantage of filing tax return, even if your tax liability is zero.
And anyways, income tax department has mostly, means if you have any sort of income, in most cases income tax department has that in their records with your PAN card. Like if you are getting any interest on your savings bank account, so that anyways goes into your records. So if you file returns on that, then it gets like official. So tax filing is means sort of a no-brainer. It has become so easy now that you should always try to file your taxes and avoid not filing of taxes.
All right. Sure, Nitin. Thanks. So just taking a couple of other questions. We have Arbinda who's asking us, could you please give us a calculation of tax with 8 lakh salary, new tax regime with less rebate under Section 87A and 25,000 above 7 lakh? So you can read this question as well, Nitin and Bilaji. Question sounds interesting to me. I'm interested to know more about this as well.
Yeah.
8 lakh salary, new tax regime. I think we'll. So Nitin, in this case, obviously there's a standard deduction and that's it, right?
Yeah,
remaining.
so on 8 lakh salary, there will be a standard deduction of 75,000. Then the 87A rebate will not be applicable because you are on more than 7 lakhs. But there is a separate clause for 87A where if the difference in the salary is less than the actual tax that you are paying, so you'll only need to pay the difference. Like for example, here what is happening is your at 85,000 salary, sorry, 8 lakh salary, you are being charged for 7.25, right? So let me just do a quick calculation on that. Yeah, so under the new tax regime, the tax comes out to be 23,400 for 8 lakhs.
So
Now
7.25, 5% you are applying, right?
yeah, yeah. And then 25,000 on 25,000 it is sorry 25 2,500 tax is applicable for 25,000 extra above 7 lakhs. So that makes a total of 22,500. Add the 4% cess to it, so it becomes 23,400. So that is the calculation from this perspective. But since 87A would have given a benefit of 20,000, so at 8 lakh, I'm not sure if that indexation benefit will be applicable or not. But yeah, closer to, suppose we are talking about 790, right? So if 790 is my income and 775 gets zero and 790 gets more than 15,000, that it makes no sense, right? Because I'm getting 15,000 more salary, but I'm paying more than 15,000 taxes on that. So that's where that clause comes into picture, where 87A provides you that difference thing, that if your taxes are more than your additional income, that you only pay the difference of the taxes, not the whole amount.
Okay, right. So we have one more question from Pradeep Sinha. Is it safe to go for a ATG? I think all are aware about that, but I'm not aware about deep complications that can arise from this. Can you please guide us a little on this?
Yeah, ATG is donations towards different entities, and there are 4 different sections within ATG where you can get 100%, 50%, 100% with limits, 50% with limits. So those are the 4 sections within ATG. So yeah, I mean, so if you are donating to some institute, then this is perfectly all right to claim for that. So you just need to make sure that you get a donation receipt from that, which mentions their PAN number and their details.
All right. Thanks, Nathan. We have one more question from Snehal. Snehal asks according to the new tax regime, how should we take the declaration from employees? New tax regime. Okay, would you like to answer this, Nitin or Birlaji?
Yeah,
Nitin,
Primaji, you can take that.
Exactly. So we have a webinar on this as well, Snehal. We would request you to join Credili's webinar where we teach you what tax scheme is better for your employees and how to collect declaration. At the first place, you're talking about the new tax regime, but we also teach about how to collect declarations for the old tax regime in our webinars. So we'll share the link to that as well. We request you to join that webinar. I'm just checking if we have missed out on any questions. No, I think we are pretty much done with the questions as well. Anything else that you would like to add towards the end, Birlaji and Nitin?
I think file your own tax return. I think that is the biggest thing I can tell. Don't be scared of the tax department, and you know, filing your tax return is I think, a eye opener for a lot of us, including me. Okay, I've had enough times where I had a finance department, somebody else filing tax return, but yeah, I think Nitin, you want to add anything?
Yeah, I think the mantra is to get more control of your finances. So taxation is one part of it, and of course personal finance planning is another part of it. So both go hand in hand. So yeah, that is something, if you take more control of taxations, I think this will also raise awareness within, means you'll also get more knowledgeable about other financial aspects of this.
See, the thing is that, a lot of us are afraid. We are scared of doing it for the first time. And, we always think that what if something goes wrong? What if I enter a wrong value? What if I give out some wrong information to the government? Like, what really happens? Is it really necessary for us to be scared of that? Is it really necessary for us to be too cautious about it? Like, what really happens if something goes south?
Most of the things are auto-filled now, right?
Multiple,
So
yeah.
I guess probability of doing mistakes has significantly reduced, right? And you can file a rectification if there is a problem, right, Nitin? I think that option is there. But I think
Yeah.
most of things get auto-filled, and for simple scenarios where we are talking about salary income plus capital gain, the probability of doing mistake is very low, because you're using Zerodha or anybody, Coera, they'll give you a report. You just have to cut and paste the number. It's fairly straightforward. Means what I'm saying is, if you want to be still cautious, maybe instead of filing directly on income tax, you can use Clear Tax, Tax Buddy, a lot of these tools, right? They will provide you an import mechanism and they will reduce the probability of making those mistakes. Those are the three levels which I talk about, that file it yourself, income tax website. Second level is, if you're not that comfortable, use one of these tools. Means I personally use tools. For example, I don't file it on income tax website. Nitin obviously is a veteran of filing it directly on income tax website. And otherwise, the third option is, which probably avoid, is unless you have very complex scenarios, is going to a CA and asking him to file.
Yeah, what we are covering here is mostly basic scenarios where we have income from salary, income from interest, income from capital gains, dividends, these basic incomes, right? Now, when we have just these basic incomes, so there are ways to know the actual numbers of for each of these things, right? Like your broker's account statement will give you anything related to capital gains. Your bank statement will give you anything related to your interest incomes. Brokers, personally in my case, I use Zerodha. So Zerodha's statement also gives me the dividends. They know my holding, they know the dividend declared against those things. They calculate that and they give that to me. So that also comes from there. So it's a single number which we have to fill. Then your salary comes, all the salary information comes through your form 16. Any exemptions you want to claim, any deductions you want to claim, that you anyways have to report to your employer, get it added to your form 16. So you might not even need to look beyond form 16 for all those deductions and your salary part. So these 3-4 documents are sufficient to get started, and I don't think there's anything to be afraid of. Means there isn't any complications from the compliance perspective. And anyways, the if you file a wrong tax statement or means return, then you have an option to rectify that within the same year. So that option is always there. So yeah, means there's no need to be afraid of these things. Get started. I think the best thing is to take the first step, start planning, start knowing what from where money is coming. So budget is what? Budget is the knowing what money is coming and where money is going. So if you know these two things and you can plan the money going towards the saving of taxes, then that's the best part.
Right. Thanks for that, Nathan. We all hope that we all become like you. We all start filing our taxes by ourselves. Yeah, thanks for that. Thank you so much for this wonderful webinar, Birlaji and Nathan. It was wonderful listening to you guys. We hope we'll connect soon again for another topic.
Sure.
All right. Thank you all so much for joining this webinar. We'll also have this recorded webinar will be uploaded in YouTube. So we'll share the link with all of you. Thank you, guys. Thank you so much. Take care.
Thank you.
Thank you.